Well, good morning, everyone, and welcome to Experian and SBFE Analytical Insights, Disruptive Strategies to Empower Small Business Lending. I'm Gary Stockton, and we'll begin in just a moment. We've got people gathering, and our panel is here. So give us about another 40 seconds, and we'll get underway. Now we're going to try and leave some time near the end of the session to take questions, and these can be submitted in the panel using the Q&A, the questions box that you should see in your GoToWebinar applet panel on the right side of your screen. We'll also be inviting you to share your perspectives during the session by answering a few poll questions. So we appreciate your participation in that and making truly a collaborative talk with this great panel. And now I'd like to introduce your moderator, Greg Carmian, Experian's Director of Product Management. Greg?
Thanks, Gary, and welcome everyone. We're excited to have you with us today and to have this opportunity to highlight some of the latest trends and how small business risk analytics are being applied to address today's rapidly changing market conditions. My name is Greg Carmian. I'm a product director with Experian's Business Information Services Division, and I will be your moderator for today's Analytical Insights webinar. Our guests today collectively represent decades of analytic and modeling experience. Joining us today is Dana Wickland, Head of Models, Analytics, and Forecasting at TD Bank. Dana is accountable for small business lending products and supports risk analytics for TD's over $3 billion small business lending portfolio. His responsibilities include model ownership for critical origination and account management decision support, models within the business, and it's very nice to have you with us today, Dana.
Thanks, Greg.
Our other analytic expert is Brody Oldham, Experian's Senior Director of Commercial Data Sciences. Brody leads a team of statistical consultants, as well as remaining an active strategic statistical consultant within the Commercial Data Sciences team. Welcome, Brody.
Thanks, Greg.
Today we'll be discussing some best practices in how our guests' approach to modeling, data governance, and diversity are evolving to address the challenges facing small business lenders in today's marketplace. But before we move into our conversation, we have a special guest joining us today. It's my pleasure to introduce Elizabeth McDonald, CEO of SBFE. Elizabeth, since some of our attendees may not be familiar with the SBFE Financial Exchange, can you please share a bit about the SBFE, how it's unique, and why it's such an important part of the small business lending ecosystem?
Thank you, Greg. I'd be delighted to, and I'm so pleased to be on this panel with you, Brody and Dana, both of whom are very good friends of ours. For my SBFE friends watching at home, I'm sorry I'm not on camera. Having a little bit of technical issues on my end, and I feel like I got all dressed up for naught. I could have stayed in my old t-shirt. In any event, we are delighted to participate on this panel, and I will talk for a couple of minutes about SBFE. So we are a trade association, technically the Small Business Financial Exchange, which is a mouthful, but known as SBFE. We were formed roughly 20 years ago to help provide more efficiency and transparency into small business lending. Today, we have roughly 135 financial institutions that are members of the exchange. They all provide credit to small business. That's the criteria to be in our trade association. We have everything from the very biggest FIs to leasing companies to captive finance companies to smaller trade associations, smaller alternative lenders in our model. But as I said, roughly 135 members, and they provide information on roughly 37 million small businesses in the US. We think we have the largest aggregation of small business credit payment performance information in the country. We have roughly, the last I heard, roughly 400 billion in small business credit in our data, and we think we have the best insight and best information on the health of small businesses in this country. It's important to note some people think we're a credit bureau, which we're not. As I said, we're a trade association. We are governed by a board of roughly 20 of the largest FIs in the country, and they very much focus on making sure that the data that our 135 member institutions contribute is protected, it's governed, it's kept secure, and is used appropriately to help small business lenders make better credit decisions. So I will spend a second on how the model works. If Gary, you want to go ahead to the next page. So we are what we call a give to get financial exchange. We're a closed loop financial exchange. We help, as I said, help lenders to small businesses make better, more informed credit decisions. So if you follow me here on this chart, step one are members, again, financial institutions of all sorts and sizes, from biggest FIs to smallest community banks to credit unions. They become members of the trade association, and they then contribute, at least on a monthly basis, their information on their small businesses, how their small businesses are performing from a credit payment perspective. Are they paying their loans on time? Are they using their credit cards? Are they maximizing their limits? Are they defaulting? Are they seeking deferrals? So all of the information on the credit health of their small business customers. We then, SBFE, bottom right corner, if you will, we gather all this data in a data warehouse that we own and oversee and govern, and we normalize that data and make sure the data is accurate and consistent. We then output that data to what we call our certified vendor partners. That's a name for the 4 credit bureaus that work with us: Experian, Equifax, Dun & Bradstreet, and LexisNexis Risk Solutions. So Experian then gets that credit payment performance data outputted from our data warehouse, and they use what we call SBFE data, but it's really the data that we've collected from our membership. They use that data to develop credit scores, portfolio management products, credit management tools that then our members are entitled to buy. So you can only purchase the scoring tools and the analytics that our credit bureau partners like Experian develop if you are part of this give to get model. We believe that based on the SBFE data, as I said, we think we have the most robust set of data on the health of small business in the country, that an Experian can develop best-in-class products and services that our members, the financial institutions, then use to make credit decisions and monitor their portfolios. So with that, I think, Greg, I'm going to turn it back to you. You're a wonderful partner of ours. We're happy that we got a little bit of airtime at the beginning, but this is really your show, so back to you.
Great, Elizabeth. Thank you so much for that overview. As we look at the economic landscape today, we're continuing to see signs of growth, but we're also seeing increasing headwinds. The good news is that as of June, commercial originations were up over 400% from the same time last year, when lenders had recessionary strategies switched on. Delinquencies are at pre-pandemic levels, and lenders have turned off recessionary tactics and are targeting growth. But consumer spending is slowing with the fear of another COVID spike as we head into the fall, and we've recently seen parts of the country devastated by severe weather. Additionally, as recently as last week, we saw the US Census report that on average, 34% of US small businesses were struggling to find paid employees, and over 42% are seeing domestic supply chain delays. So Dana, against this backdrop, how are analytic tools and techniques informing your growth strategies while helping you maintain a responsible risk posture?
Yeah, thanks, Greg. So it's it's a tricky balance, right? So when we were going through the pandemic, we saw our delinquencies skyrocket virtually overnight to twice what we would see in the normal portfolio. And kind of as we moved through the pandemic, we had very heavy support from the PPP program, from SBA payments, and then my bank, like many other banks, did internal deferral programs. So the small business lending ecosystem, if you will, had very, very heavy support. And I think, one of the biggest components of that was the PPP population, where there was a percent of that population that used some of that PPP money to sustain the obligation that they had with my institution. And I'm assuming that that would be an industry trend. So once the pandemic is sort of, vaccines are out, once it became a little bit under control, the internal shift like immediately pivots back to growth. And so a couple of the actions that we've really engaged in 3 different things. But these things also started during the pandemic or a little bit before, and we were able to see some more action on them, now that we're kind of through that a little bit. One of the things we did was we introduced more sophisticated techniques in our marketing and targeting model for small business, making use of different data sources, using AI techniques to connect our retail businesses with our small businesses to better understand small business consumption behavior relative to lending, our lending products. We also introduced new risk sources into the data that we use to revise our risk models. And this is a webinar on analytics. It's not an infomercial for the SBFE per se, but we did build a model with Experian where we saw a significant lift over traditional small business credit data sources. And we're working to implement that model now. So better able to isolate risk, better able to target. And then the last piece that we did was did a lot of programming on segmenting the portfolio for delinquency hotspots in certain products, and also analyzing it with risk and financial engineering to understand where the greatest economic value is for us under these new market conditions. So really it comes down to, marketing efforts, risk assessment efforts, evaluation of data, bringing those together through the right methodologies to address a pretty dynamic situation.
Dana, I think that's really important when you're talking about some of the tools that you're using to address this. One of the ways that we start is by visualizing, just like you talked about, and some of these charts here that everyone sees are from our SBFE data. And when we evaluate, it's creating those benchmarks across against the market that's out there, looking at where competitor groups could be playing within the market, how we can see opportunities within different locations across the country, where delinquencies are rising and where they're falling. One of the good parts when you're beginning one of these engagements, trying to change your risk policy, just like Dana said, once they hit that February, March timeframe, we start to see delinquencies come up. Your risk strategies flip on that recessionary policy. How that's impacting your ability to originate new loans. What does the market look like? Are they doing the same thing that you are? So creating these visualizations are very important. Now, one of the things on a platform like this where we're including SBFE data is bringing in some other source data so that you can evaluate not only what we're seeing from a geolocation level, which you can see examples here, but looking at it from the perspective of macroeconomic data, looking at accommodations. And we mentioned accommodations, Dana mentioned on the commercial side. We see accommodations, forbearance, payment deferrals, holidays on the consumer side too. And when we link together that guarantor or small business owner with their business and put those together, there's some powerful insights that we can gather just from these visualization tools. And we can see that those small business owners that got an accommodation on their consumer credit fared better than those that didn't. And so a lot of times it's education of your customer base. You can find opportunities just to engage with customers where it may not be direct engagement for a credit product, but it could say, let me help you a little bit to learn a little bit more about how to improve your credit score so that we'll have opportunities to interact more in the future. So visualization I'd say, Greg, is one of the things that we see as very important when we're starting down this road of developing a strategy, model, attributes, anything from an analytic perspective.
Great, yeah, Brody, I think it's the power of being able to see the view of that combination of the consumer and business performance as well. And so that's very powerful in what we can do with that visualization. So thank you both for your insights there. As we move into the next area of discussion, we'd like to get a sense of how your company may be using machine learning in small business risk assessment. So we're going to take an instant poll right now. We'll take a few minutes to allow you to input your responses before closing out the survey. So go ahead and enter your response now, please.
So the poll is opened up. We can see people are registering their selections. We've got about 40%. Yeah, let's get it over 50% voting. We'd love to get majority of you participating in this poll. I can see a consensus there. We're going to go ahead and close the poll so we can share some results here. We had 61% voting, and I'm going to share the results. You should see the results on the screen now.
Very interesting. Yeah, this is very interesting. Seems most are considering adopting within the next 24 months. And what's really interesting about this, Brody, is artificial intelligence has been such a hot topic, and Gartner recently predicted that 75% of enterprises are going to be shifting from piloting to operationalizing AI by 2024. So, given the window, it seems like a lot of the folks on the webinar today are aligned with what Gartner has been seeing in the marketplace. So can you share with us, Brody, a little bit about how machine learning is different from AI and how machine learning is really allowing us to maximize the predictive impact of SBFE data and other data sets in predicting small business risk?
Sure. When we think about it, I look at AI and machine learning, you can say they're the same thing or a portion, and we look at machine learning for credit as a segment of what we would consider artificial intelligence. And of course, as we look at how we're using these methodologies across the business, fraud has really been the big place where it's settled in for decades. We've been using this type of methodology. Over the past couple years, really the focus on credit risk and how to incorporate these methodologies in that, in the past had been considered black box types of methodologies to get an answer from a commercial credit profile, taking that to an indecision or a score. It was hard to have that traceability and explainability. Well, now we're at a point where we're past that. So with lifts of our commercial machine learned credit scores that we have out there, we're seeing 20% plus really lift in our general statistics that measure performance as we go forward. So even lifts in KS, we've seen great performance. When you think of a machine learned model, or older methodologies may have used, 30 to 100 attributes in them. Now we can expand that to a broader view where we have models, even our standard generic models, that'll use 700 plus attributes within them. And what's important here, when you expand this out and you get a broader view, you really get a good sense of how a small business is performing in the market. You're able to bring in more information and different information into a model and be able to assess and create a decision for a service provider that's really making some accommodations for that small business. Now, when we think about it as well, what are we trying to do with machine learning is we want it to be explainable and we want it to provide consistent decisions. So what we found that has been important in the deployment of these types of advanced methodologies is that we do a static deployment. Now you can do a dynamic deployment where it continues to learn and gets that feedback loop and changes as you go forward and decisions change. But as far as our regulators are concerned, they want consistent decisions and they want consistent outputs. And if I think of myself as a small business owner, and when I check my credit score, I want to know what's going to make it better. How do I get up a tier so that I can get access to more affordable funding for my business as I go forward? So creating that static deployment allows adverse action reasons, or those factors that play into why my score is what it is, to really know as a small business owner what I need to do to change. And so with these static deployments, you get the same answer every time. If I need to improve my ability to repay, my delinquencies, my utilization I need to bring down a bit, it tells me that on the output. So, and consistently, so it doesn't change. So I think those are important, especially when we get to a regulator. They want to see that it's consistent in what's coming out. Now, we definitely take that into account when we look at these machine learning models, and that's been some of the feedback that we've gotten from clients, is saying, I'm moving from something that's very traditional, tree-based a lot of times. They can follow the nodes down and say, all right, and you'll see an image of this here with a single tree, and they say, this is why I made the decision at this price point and why I'm providing this product to a customer. In a machine learned version of this, you may have 1,000 trees. And so you want those answers to be the same. Even if I go across 1,000 trees, my adverse action reasons need to be consistent. So being able to walk through with a regulator, compliance, or legal group to talk to them about how it's performing. Does it follow fair lending guidelines? Is it performing in a way that gives that consistency? Can we show traceability through the model to show them how we got to the decision? We can certainly do that. And one of the things that we offer that I think is a good suggestion anytime you provide one of these machine learned methodologies or introduce it into your business is have an opportunity for either internally or a consulting group that we would offer from Experian to come in and speak with your legal and compliance group, walk them through how decisions are made, show them a little IP, and make them feel comfortable and warm and fuzzy about the decisions. Certainly for a 20% lift, some great improvement there, it's definitely worth it. So Dana, I know you've worked with us a little bit through the process. Why don't you talk a little bit about some of the experience that you've had looking at some of these new methodologies?
So what I can say is the bank that I work for has a decades-old reputation for being conservative and being in the good graces of both Canadian and US regulators when it comes to methodology. We, like a lot of other banks, have engaged in exhaustive processes to button up our validation, model governance, data governance, and oversight processes over the years. I would say that my institution, according to this poll, in the majority of 83%, are kind of in the adoption of machine learned techniques. But one other thing about my institution is that we will not be left behind when it comes to servicing our customers, developing new products, providing greater loans to the communities that we lend in. So it's been a slow process. We actually went outside the box, I guess, one way to put it, and acquired a machine learning entity a couple of years ago, essentially an analytic software company in Toronto, and have integrated that into our ecosystem, I guess. And so that group, amongst others, is purveying machine learned models within the organization. So I would think we're breaking through that cultural barrier of the issues such as traceability, the sophistication of the models, the adoption of different model development reporting techniques within our model governance framework, if you will, to try to get these things into play. And the lift is there. We've seen examples of that. So I would say at this point, we have a lot of different business lines, but there is integration taking place and a recognition that we can move beyond linear techniques into machine learned techniques to, again, it's about our customers providing greater levels of lending and penetration into the communities while respecting the risk appetite and our responsibilities to our shareholders.
Have there been any challenges that you run into with model governance as you've been introducing these machine learned techniques, Dana?
If we go back, I think maybe a few years ago would have been like, no, we're not going to do that. We've progressed our model risk governance to have, part of getting a model through validation is producing the data, producing the documentation, producing very specific development reports, and that cover all aspects of the model development. So we've come out with actually a variant for machine learned models that's a different type of report. It goes to the sampling, it goes to the software, it goes to things that just don't apply to traditional modeling techniques. So the model risk governance framework has adapted to allow for machine learning and artificial intelligence driven solutions, both from vendors and from internal modeling groups. Hopefully that helps.
Excellent. Yes, thank you. It does. Thank you both. So the next area we want to move into is alternative data. And we've seen alternative data as a key area of interest to our clients for several years. But with the rapid growth of digital commerce because of the pandemic, we've really seen an acceleration in interest in non-traditional data sets. And so it seems much more now to be a combination of both. And how do you create a good balance between the two? So, obviously we have traditional specialty data sets like SBFE, but then we also have other, new data sets like permission data, point in time data, macroeconomic data, just to name a few. So Dana, how are you incorporating these data sets today or thinking about incorporating them into your processes in the future? And are there specific challenges that you've identified with using these types of data sets?
Let me see if I can give a decent answer to this one. So ships, large banks are kind of like ocean-going ships, right? Very difficult to turn them on a dime or to sort of change course rapidly. Although with the pandemic, as I said earlier, we did that quite a bit. We've introduced a digital portal, digital application. With that comes additional permission data that we can use. We've looked at and tried to integrate macroeconometric data into our risk models, into our marketing models, where they can be effective and be manageable. That is one of the challenges with that is the point in time aspect of it. I think the biggest difference in data really has been we do integrate application data into the models, which allows the app to be driven to different scorecards. It might make use of financials where they're available to gain greater insight into the ability of a business to debt service, which also gives us a higher level of predictability and allows us to set more aggressive strategies because we've got a better outcome or a better predictive outcome. Going back to the SBFE, that's a major difference over traditional business data sources in that the data is very high quality. It's very pure to bank exposures. Recent risk model that we used had a near 20% lift over the industry standard model that we use and have used for many years. So again, it's probably, I'd almost say neck and neck with the machine learning aspects in that the migration, probably 40% of our applications for small business are coming in digitally now through our online app. So how we harness that data through new or evolving origination systems and then bring them to bear in an analytic environment. It's not something that happens overnight, but it's recognized that there's additional analytic value to be had there.
Dana, I definitely see that. When we look at this type of information, you're bringing it in and creating some incremental lift. And I think that's good from our core traditional data sets that we've used for credit decisioning in the past to these non-traditional sets that we're bringing on board to add some incremental lift just to get us a broader view of what a customer looks like. And certainly from a small business perspective, that's important. And it goes across the life cycle. Again, it's easier to put this non-traditional data into a process on the front end that looks at fraud, where you're bringing it in and you're not really giving an adverse action on the back end. You're not declining them, they're just taking it to manual review. And so putting in some of these non-traditional sources is pretty easy. When we get into credit risk and we're looking at portfolio management, upselling, cross-selling, or you're looking at what you have as far as an onboarding activity and review. I mean, our SBFE data, that core credit data that we have that we're bringing together with other data sources within the Bureau is really the core of the decision making, but we can add some of these other sources of data to give ourselves a broader view. And what we really look for is that historic sense in the data that allows it to be auditable, and we can repeat a decision once it's come through. If you know, as a small business owner, if I went back and said, hey, Dana, how did you calculate my score, you know, 3 months ago, to be able to recreate that score is important. And that's what's been challenging for point in time type of data that you've seen. A lot of our social data that's out there in the market now are really one time. You can get it today, it'll be gone tomorrow. You know, sentiment data can be gone tomorrow, but if you're able to capture that as you make a decision and log the data and how you've made a decision and the values at the time of scoring, that can help to make your internal compliance a little more accepting of this type of strategy to bring in point in time data, because you're really capturing the information that we use to make the credit decision. So that's helpful. You know, a lot of big data is out there too, where you can determine signals that are out there. Are there buy signals for your customers? Are they interested? Are they in the market for a particular product? So being able to use this type of big signal data, identify businesses that are out there shopping around, a lot of time can help create opportunities for you to stint a little attrition out of your portfolio. Certainly if you're trying to continue to grow what is there in-house and your most profitable customers, keeping those guys happy. Customer experience is a big deal. And certainly as we come out of this pandemic time period, you know, as Dana talks about customer experience and digitization and how you're interacting with customers, that customer experience, knowing them a little bit more, having a broader view of what their interests are and what else they're working in and dabbling with and what other businesses are they connected with, can make a real difference in how you can support them in their future funding needs. And, you know, as a small business owner, it helps me if I didn't quite know what I needed, and Dana offers me just a little bit of additional funding to help me invest and grow in the future of my business, makes me a little bit more resilient and appreciative of the work that they're doing, really to know the needs that I have available, and grant me a little bit more credit than I may have gotten without this non-traditional data. So it plays a role really to have that customer experience. I mean, our mission at Experian is to help the small business owner. That's what we're doing with our data here. That's what we use our SBFE data to do. It's what we're bringing in this non-traditional data to do. If that's your goal too, that's really what is important with this data, is really getting a holistic view and creating opportunities for that. And, you know, partners like Experian can help you to determine what types of data sources are easy if you're more conservative about your strategy, but also if you want to stretch the limits a little bit, talk to you about some of the risks and some of the advantageous nature of some of the more out there types of data. So looking at the big data environment. So a lot to view out there. Certainly partnerships are good to have.
So it sounds like more informed risk decisions, but also better understanding of your customer. Really,
that's right.
Better, more nuanced understanding of your customer.
Mm-hmm.
I was going to maybe just add in, Greg, before we depart this topic. So my institution, like many, are on a path to enlightenment on customer experiences. So, you know, who are our customer segments? What is it that they need? And then ultimately, when do they need it? And in what combination that produces the greatest value for my shareholders? So all of that requires, you know, different data, non-traditional data. And I think the three of us have been in this industry long enough to know that depth and breadth of data and new sources of data run up against that depth and breadth in use, testing, and development. So I think every institution should ask themselves, how well do they know their customers? How well do they segment their customers? Can they predict what product combinations are best for their customers and best for them? But also, when is the right time? And it's a long road, but I think the non-permission data is a piece of it, an important piece.
And Dana, I'll jump on that just a little bit more. I know Greg will make you smile here as we get into our talking mode. But I would say too on that, if we look at adverse action codes coming out of this and factors that go into models that we build with non-traditional data, as Dana talked through the steps, at the end, you want to help that small business owner. And we want to make sure that what we're showing them as the reason why their score went up or down is reasonable. So, we've run across factors before that said, it's because your street has cracks out in the front that we're not going to give you a loan. Okay, well, is that the business's fault to drop their score 20 points? Well, probably not. It may be a predictor of how that business may perform, but again, it's not reasonable for a business owner if you're trying to help them or understand why or how to bring up their score to get cheaper funds. So I think use case is very important when evaluating this type of non-traditional data, and taking a step back and thinking about who we're servicing is important when we bring in this third-party data, because we want it to be reasonable and explainable from the regulator all the way down to our customer that we're trying to create a great experience for.
And just maybe to bring that back to user reality. So sometimes things like industry, the age of the business, its tenure, its structure, those are sort of non-traditional methods that we can use to better understand risk, both for opportunity and for risk reduction. And they're not usually found in a standard credit report.
Yep.
Yeah, and that customer experience is so critical in stickiness and really getting the customer loyalty right over time. So definitely an impact there with the non-traditional data. Well, thank you both. The last topic today that we'll be covering is diversity, equity, and inclusion. And we'd like to share, we'd like you to share which of the following best describes your company's level of engagement in this area. So this is our second survey. So please feel free to enter your responses now, and we'll see what the temperature of the webinar is today.
And we can see the responses starting to come in. Thank you, folks, for participating. We'll see if we can do as well on our participation rate on the last poll. Great discussion today, guys. Enjoying this. I'm learning a lot. Okay, I'm going to go ahead and close the poll and we'll share the results.
All right. So it seems like the majority are in progress, is already making solid progress in their engagement around diversity, equity, and inclusion. That's great. There also seems to be a very large proportion that's best in class. So I can see that we have people represented in the webinar that are in all three stages, but really nice to see that strong progress has already been made. And this issue of diversity, equity, and inclusion, it really leapt into the public consciousness following the social upheaval of the summer of 2020. And I think what it did, it really cast a bright light on the challenges that diverse business owners face. Based on a Federal Reserve study that just came out this year, nearly a half of Black-owned business owners, or Black-owned businesses, I should say, reported concerns about personal credit scores or the loss of personal assets, and that was twice of white-owned firms. Earlier this month, the CFPB has also issued a proposed rule amending Reg B to implement Section 1071 of the Dodd-Frank Act, which would require covered financial institutions to collect and report to the Bureau data or on applications for credit for small businesses, including those that are owned by women or minorities. So Dana, as you approach financial inclusion, what are some of the challenges you're seeing, and how are analytic tools, or how are you using analytic tools to become more inclusive?
Yeah, that was interesting. That 33% of the respondents felt they were best in class. I think this is a topic on the organizational side, on the lending side, on the reporting side, that probably is a long way from being best in class across the industry. I think it's a continuous process that's going to go on for quite some time. You know, I look at my institution, do we place a priority on our teams being a reflection of the communities that we serve? Absolutely. And I think that we always have, but I think over the past, I'd say, number of years, not just since a couple of summers ago, that's been a very important thing for TD Bank. You know, some of the challenges are whenever you change reporting dynamics, that means that data models have to change. It means that the collection of data usually goes to change. It flows all the way through. So applications, decision support systems, mainstream data models that provide the reporting, the governance over those data models, and then making sure that we have the teams built out to look at you know, all of that. So I think my institution is on the way for sure. We look at this upcoming, you know, the 1071 regulation, I'll call it, and that means going to multiple lines of businesses and saying, you know, what's your plan to address your data flow from end to end? And so everybody on this call understands that the change in data systems, models, underwriting processes, and flows to affect the collection of data is extremely difficult. So this is something I think that's going to be a topic of conversation for the next 5 years. You know, the challenges are definitely, you know, redesigning applications to collect that, making our customers understand why it's necessary, why it's important, making sure that the quality of that data flowing through our systems is producing the, you know, an accurate depiction of our markets, and then structuring the reporting correctly, and then making sure that the learnings that come out of that reporting, both for the regulators and for the bank, are done well.
Dana, I think you hit all the important parts here, because really it does go through your whole business. And when we look at, you know, our customer base and customers, including you, you know, we have some that are just at the very beginning trying to figure out how they're going to capture the information from a customer in that customer experience, you know, that they're having to say, you know, I need this additional information. It's now required where it hadn't been in the past. I think in ways that we look at, you know, enhancing our system. So some of you may be using a BizG methodology where you're appending an estimate of what diversity or an ethnicity type of a flag might be for a particular business. And so those methodologies play in. One of the things that we do here also is use curated data. So data that we've been pulling together for a couple decades now on diversity indicators that have been reported by the company themselves and verified by other partners that we have looking at this type of more truth type of data for these populations. Now, when you look at it, we have these indicators available for customers, but how are our customers using it now? They're not really placing it in their strategies as a credit decision on a particular segment of the population, but the way that we're working with our customers is to look at it from an evaluation of their performance. So if you create a business strategy outside of the diversity and diversity indicators, you create this strategy, you say, oh, I'm gonna, you know, evaluate this particular segment of my portfolio, and I'm addressing a next move to upsell or cross-sell this population, and I'd like to understand if the policy change that I'm going to make or this offer that I'm going to make is going out to a diverse population. Once that pool is put together, we'll take a look at it and give them a breakdown of how well they did with their strategy. So really it's evaluating once they've sent out that campaign and it comes back, were different segments of the population picking up that product? Was it acceptable? Do they have the right types of products going out to different groups for acceptance, and eventually booking and bringing it into your portfolio, your family of loans that you're servicing? And then we look at how you're addressing different challenges that you may have, even through pretreatment strategies. How well are you addressing diversity and equity within the collection activities that you're working, and that certainly will make a difference as some of the moratoriums come off the books. You're going to have more customers that are going to be challenged by some delinquencies going up, some additional debt loads being put back on to the business owner, even onto the business. If we look at different energy bills coming back on that have been on moratorium for collections for a long time, now that balance is reassessed to the customer. We'll see more of those come in as well. So just how are you doing as far as applying equal strategies across customer bases? So those things are important. I think as we go forward, it's really is just having a sense and some type of being able to look at how you're progressing. Are you really best in class? Are you working your way toward that? Certainly, what strategies can we put in place or help you with that would move you in that direction to make you, if you don't feel like you're best in class yet, how do we get you there? And we certainly look at it from an Experian culture side to say, we do a lot here as far as how we're addressing the market, how we interact with our communities around us. We interact with community focus groups that really try to get activity, our people on the ground, and a lot of you are doing the same thing. How can we take an action to impact the future? And so as we do that, we try to apply that here and create strategies within the credit market as well. How can we help you do that same thing, not only out in your community, but here in the credit market, and get those diverse communities that have been underserved to get them back into the market and up and functioning in a healthy way, to get their fund costs to go down and to make them more resilient as we go forward. Very important to take your personal culture that you have and apply it here in the business that we do. It makes your mission of helping small businesses just align, and it makes you flow as you're engaging your customers.
Great. Well, thank you both. We have a bit of time left for some questions, but before we go there, Brody, if anyone in the audience is interested in learning more about SBFE, Experian's SBFE solutions, analytic tools, or our analytical consulting capabilities, what should they do?
Well, Greg, that's pretty easy. We're going to give you a couple easy ways to do this and interact with us and engage. We'll have 2 emails that are coming out. One will be a survey just on how the session went today, perspectives, and even some comments that you might have to make our next one even better. But on that, you'll have an opportunity to ask if you need some help or just want to talk for a little bit about some of the strategies that you have in place, get some ideas from us, and we're certainly happy to collaborate and just talk with you for a little bit and give you our perspective on where to go. You'll get a second email that'll ask you if you want some type of whiteboarding session with us. Can we go a little deeper, show you some of the visualization tools? That's certainly available too. We do that. We're happy to engage you and happy to help you really get a sense of best in class, how you compare to the market, and where you can see yourself going in the future, and really creating that strategy to go forward. So happy to do that. So look for those 2 emails coming up.
And I feel very lucky to have been able to participate in this session, because you all have done a wonderful job publicizing SBFE and the lift from our data. And I just want to reiterate that while we have the very largest lenders to small business in our model, we also have very small ones. And so we have lenders that might be a local community bank that has a portfolio of 1,000 small business customers, and they are very welcome in our model as well. So we take, really any kind of institution that makes credit available to small businesses, and we work well with Experian, and we can work you through the process in a pretty easy way.
Great, thank you so much, Elizabeth. So in the time we have left, we'd be happy to field any questions you may have. Gary, if you could just take a look at the queue and see if we have any questions. We'll give it just a moment here.
Yeah, we had a question that came in from Matt, and the question is for Dana. And Matt asks, what segments do you find the SBFE information gives you the most predictive lift?
Interesting. So hey Matt, so the majority of our portfolio is working capital lines of credit on the lower end, and we've had a lot of growth over the past 5 years with SBA guaranteed loans, and like 80 or 90% of those loans are help us with our CRA rating and LMI assessments. So it's kind of a combination of meeting our customers' needs and also achieving those levels of penetration in the portfolio. So I would say the SBFE data in terms of a segment, if you're small business, say under 25 employees, exposure borrowed under $150,000, maybe even under $100,000, you gain the greatest lift because you've got a combination of heavy influence of the consumer attributes, but also a big lift from the SBFE's bank-specific trade lines into the model. So we were able, I guess the best way I could sum it up for you, the model that we built was a very sort of diverse model in terms of its sources and covering the 5 C's of credit. And the SBFE really helped out on that sort of lower end set of exposures. So I would guess sort of revolving lines of credit, maybe mid-tier credit quality, maybe under $100,000 to get an awful lot of lift from the SBFE. That does not say, before Elizabeth jumps in, because I am a board member of hers, that
You're doing great. I wasn't going to jump in.
That's just, Matt, that's just where we have exercised it to a certainty. How about that?
Oh, very good, very good. Elizabeth, anything to add?
No, Dana, that was wonderful. And I think I've talked about the range of financial institutions that can be our members in our trade association. So in addition to, I've talked about, leases, but we have a huge representation of credit cards in our portfolio. And obviously then the broad array of more traditional lending products, term loans, lines of credit, revolving credit, et cetera. So it's a pretty broad view of lots of different kinds of credit products.
And Elizabeth, you're moving into merchant as well, right? So
yes.
I mean, you have
merchant
new,
acquires, yes.
New expansion plans there.
Yes.
Right. So I'll just finish that off for probably everyone on the call. Once you get over exposures that are over 150,000, over 200,000, the influence of the guarantor wanes in favor of the business's necessity to generate cash flow to service that additional obligation. And as I look across the industry, once you're looking at exposures 150,000 or higher, that's where you start to see the spreading of financials in the more integrated underwriting that goes on. So when I mentioned the lower end segment a little bit, it lends itself to more automation of lending, more homogeneous decision making as a segment.
And I agree there, Dana. I think some of the good things when we talk about automation, we talked a little bit about our non-traditional data sources. When we look at those types of exchange participants that may not seem like your typical participant class, it plays a lot in. There's a lot of value in the SBFE data that we found, even for those that you might not typically think of as a financial institution or a lender. So just understanding the credit health of that customer, of that small business, how resilient they'll be. This core credit data really plays into that and gives us the history and allows us to forecast what our expectations will be as we even creep out a little bit further outside of the pandemic that we're currently in, and really markets get back to, I mean, they're at 100% in some segments. We have a bit of a K-shape, but as the rest come into play, we'll certainly be using this across all segments and seeing that growth potential really expand. So I think inside it can be for those smaller targets, but it goes through the gamut that we use this data, and we really feel that the impact is great.
Well, this has been a great discussion, ladies and gentlemen. Thank you so much for sharing your insights with us. When the webinar finishes, you will see a prompt for a survey. We really want to improve the quality of these webinars and make sure that you get out of them what you need to. So if you could please respond to that survey when the event closes, and look for an email from Experian in follow-up to a recording, and by all means share that with your colleagues, and reach out to Experian if you have any questions about SBFE. Greg, Brody, Dana, anything to conclude with?
I just want to thank Dana and Brody for your insights. Have been tremendous today. We appreciate your participation. Elizabeth, thank you so much, and our friends at SBFE for your help in making this webinar possible. And we just finally want to thank all of you for joining us today. We hope that this has really given you some thought-provoking material, and that you're going to be taking some significant benefit out of today's webinar session. So thank you so much.
Thank you.
Have a good day, everybody. Thank you.
Thank you.